Understanding bull market cycles. There are 4 stages of market cycles, and we'll talk about each one. Welcome back to the channel. I'm Vandell co-founder of Black Swan Capitalist. My brother and I simplify financial markets, digital assets, cryptocurrency, currency debasement, gold, and market cycles so that you can have an unfair advantage to strategically position yourself for success during the greatest wealth transfer in history. Markets inherently fluctuate, rising and falling in a somewhat predictable fashion over time. We all know that. Now, in the stock market, though, downturns typically occur every 5 to 10 years, while in the crypto market, they happen approximately every 4 years. That's why we have the 4-year cycles in the crypto market. You have the 4-year bull runs that take place. And of course, what's driving those is for a whole nother video. It's driven by liquidity, speculative investments coming in, and of course the Bitcoin halving is just one factor, but it's primarily driven by liquidity that comes into the market, which is by the debt refinance cycle, which happens to be every 4 years at the same time as the bull run. You can't convince me it's a coincidence. With a more granular view, these cycles can be completed more frequently, allowing astute investors like yourselves, if you're watching, to strategically capitalize on these patterns. But in order for you to do that, you have to understand the market cycles and where we are in the cycle. Now, these cycles apply to all asset classes, each potentially experiencing different stages simultaneously. So, for example, equities and stocks might be in a bull market, while digital assets and cryptocurrencies are in a bear market, and commodities could be in a recovery phase, all at the same time. Understanding the broader economic cycle is actually very crucial for investors. Markets don't move in unison. For example, the stock market typically goes through, as we said, its 5 to 10 year cycle, but not every sector within the stock market follows the same timeline, and other asset classes, such as real estate, have a longer cycle. Now that we've covered that, in this discussion, we'll explore the 4 phases of market cycles, how to identify them, and what they mean for investors like yourself. The first phase is the accumulation phase. The first stage of any market cycle is the accumulation phase. Now, during this phase, the market is at its lowest point, and early investors, the few bright ones out there, such as value investors or speculative investors, start to recognize opportunities here. This is the point where these investors, often seen as contrarians, like myself, begin to slowly buy back into the market in specific assets, perceiving that the asset is tremendously undervalued with significant potential for growth. This stage, general sentiment remains bearish as the accumulation phase follows a market bottom. Now, retail investors are typically late to recognize this shift at this point, often influenced by mainstream news that fails to provide early indicators and pretty much lies to the public, spreading fear and propaganda. Despite some signs suggesting that the worst may be over, certainty is still uncertain. Retail investors tend to stay away, driven by fear and a steady stream of pessimistic news that's deliberately being put out to keep you out of the market and put you in the wrong direction. This is just how the mainstream news operates when it comes to financial markets. Historical example of the accumulation phase is evident following the 1991 recession. Set the stage pretty much for the internet trading boom and the dot-com bubble. And the rise of that dot-com bubble was from 1995 all the way to 1999. Now, during this period, the market actually experienced extreme substantial growth after the initial accumulation phase. In summary, the accumulation phase is when investors start buying assets post bear market decline, anticipating an upcoming market bull run. Prices during this phase generally move sideways or within a range, and trading volumes remain low. This environment allows large investors, insiders, and institutions to build their positions quietly, and enables patient investors to acquire undervalued assets before the broader market catches on to the changing trend. And this is what we always talk about: get in early. The key is getting cheap prices and getting in early. Now, the second phase is the markup phase. The second phase of the market cycle is the markup phase, and what this means is this is generally the most exciting phase for investors in all markets as the market starts to shift into a bull market. It's characterized by steadily increasing asset prices driven by liquidity and growing investor confidence and optimism. This phase can be divided into three segments. The first is the early markup phase. This is the first segment. In this phase, the market has recently experienced stability and growth, primarily due to the accumulation phase. Early investors re-enter the market, spurring growth, and it's not yet alarming to most people. Now, the media coverage begins to suggest that the worst might be over. However, uncertainty among retail investors still remains, influenced by mainstream media and news. Now, the second part of this is the mid markup segment. Now, this mid markup phase sees a shift in market outlook from neutral to bullish. Several key developments actually occur during this time. The first is the late majority of investors start entering the market, obviously, trying to capitalize on rising prices. Second, early and speculative investors begin to take profits. That's like us or anybody who's planning on exiting a portion of their portfolio, selling some of their holdings as you see your portfolio go up and asset prices increase. The third is greed starts to outweigh fear for most investors. This is just human psychology. As the market's positive momentum gains traction, people take profits. And that's the people that were in early. Now, investors feel comfortable jumping back in and buying shares or crypto or digital assets on a large scale at this point. As a result, valuations often rise even more. It's typically during the markup period that the market can experience the largest gains in the shortest amount of time. The market could be nearly at the peak of its cycle. The late markup phase. This is the third segment of the markup stage. The late markup phase marks actually the peak of the cycle. This is the top. Prices begin to level off, or the growth rate starts to slow down. Investors who previously stayed on the sidelines, often due to past market downturns or just fear, start to show interest at the worst time. This includes many of your uninformed retail investors who begin investing heavily driven by fear of missing out, FOMO. Their families talking about it, their friends are saying, hey, you need to buy this, you need to get in that, and encouraging them to participate in the market at the worst time. The reality is they should have done that a long time ago in the accumulation phase. Prices surge rapidly as the new investors enter the market, and they actually believe there's still significant growth potential. However, this stage often serves as an exit point for early investors and insiders. They sell their crypto or their bags or their shares to people coming in late, and that's called using them as exit liquidity. They sell their holdings to the latecomers. Now, recognizing that market cycle, it's clear that this upswing can't last forever. You know that anything that goes up must come down. And this leads us into the next phase. The third phase, this is the distribution phase. The third phase of the market cycle is the distribution phase. During this phase, sellers start to dominate the market. The bullish and optimistic outlooks of the late market phase begin to wane and grow more mixed. It's not uncommon to observe what are referred to as double or triple tops during this period in the market. A double or a triple top occurs when market prices trade near or slightly exceed their prior peaks, but fail to significantly break higher and keep going. This phase marks the end of the market's upward trajectory, leading to a gradual change in direction and then eventually sentiment within the market. The transition in the distribution phase is often slow and can last for an extended period of time. Prices generally remain relatively constant over several months, but in the crypto market, it's a couple of months. The distribution phase is marked by a shift from euphoric sentiment, which is very optimistic and positive, to a bearish sentiment, characterized more by changing and different investor emotions that are starting to get mixed up than by significant price drops. Investors frequently oscillate between fear, hope, and greed as the market gives mixed signals that it might be gearing up for another rise, when in fact, it's not. This phase is notably extremely unpredictable, with its duration varying widely from one market cycle to another and depending on the asset class. Given the volatility and emotional swings, many investors choose to exit the market during this time, aiming to break even or at least minimize their losses. However, this is often when substantial losses occur, as investors who panic or fail to recognize the signs of the distribution phase are basically setting themselves up for failure, and they usually do fail or take a loss. After that is the fourth phase. The fourth phase is the markdown phase. The markdown phase is the stage in the market cycle often regarded as one of the most challenging periods for investors. This phase is characterized by significant price declines following the distribution phase, leading to an extended downtrend. During this time, market sentiment becomes overwhelmingly negative and bearish, and the majority of price crashes occur around this time. In the markdown phase, savvy investors typically sell off their positions in large quantities. However, though, if you're really good at exiting the market, you'd be getting out during the third segment, the last late stage of the mark up phase, creating substantial selling pressure as they sell. And this creates that ripple effect that we spoke about earlier. So they start to take profits, they start to cash out, and the price drops. And then more people see the price dropping, they start to get scared, and it's this ripple effect that continues. This often catches inexperienced buyers off guard. Now, active traders or investors who plan to take profits and exit the market may find themselves regretting not selling their investments sooner. As the market continues to drop, these investors may hold on to their investments in hopes of a rebound, but many eventually capitulate and take a huge loss. For passive buy and hold investors like myself, even though I have positions for taking profits, especially those who are new, the markdown phase can be incredibly stressful. The barrage of doom and gloom news headlines actually exacerbates the anxiety, and it can be extremely difficult to maintain confidence that a recovery will eventually occur. Now, despite the mainstream media spreading a lot of fear and all that negativity, the truth is the markdown phase, if we study history, has shown that an accumulation phase does eventually follow, with prices reaching levels that attract more speculative and value investors back into the market. Understanding the broader economic cycle is extremely crucial for investors. Markets don't move in unison. Remember, for example, the stock market typically goes through its cycle every 5 to 10 years, and the crypto market, the cycle is every 4 years. But not every sector within the stock market follows the same timeline. Other asset classes, such as real estate, have longer cycles, so diversifying investments across different sectors and asset classes can actually help mitigate your risks and enhance long-term success. Mark Twain said it perfectly: history doesn't repeat itself, but it often rhymes. While the details, circumstances, settings, and names may change, similar events tend to reoccur eventually. So, recognizing these patterns and understanding that the phases of market cycles can equip investors with the knowledge needed to navigate challenging times more effectively. In conclusion, I hope this information helps you guys. I think it's extremely important and can really give you an advantage understanding where we are in the market cycle. I think that's one of the most important things to know if you're an investor, because as people have life cycles, markets have cycles too. And remember, market cycles and the cycles are primarily driven by human behavior. And as long as humans don't change in their nature, market cycles won't change either. We can use this to our advantage to know where we are in the cycle so that we'll know if we need to be more aggressive or defensive. Anyway, I hope you guys enjoyed the video. Subscribe, like, follow, and I will catch you in the next one.